what would happen if the intersection of a whole group of nonprofit world that really wants to help people intersects the world of housing, where you actually have ownership that would love for there to be social programs for their residents, but there is a chasm that's in between that doesn't have the people, the nonprofits with direct access to residents and ownership groups that don't know about nonprofits. What if I can make that easier to connect? And there's a number of different nonprofits that are out there that can provide services to your residents. And oftentimes, as the owner, it's free.
Welcome to CREPN Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network's CREPN Radio. Thanks for joining us. My name is Jay Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Jeremy Thompson. Jeremy Thompson is the managing principal at Convolo Capital, where he focuses on acquisitions and equity relationships. Convolo is a boutique private equity firm specializing in multifamily assets in Georgia and Texas. And in just a minute, we're going to speak with Jeremy Thompson about social impact initiatives that are good for residents, employees, and investors. But first, a quick reminder, if you like our show, CREPN Radio, there are a couple things you can do to help us out. You can subscribe, like, and share. And as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Jeremy Thompson. Welcome to CREPN Radio.
Awesome. Thank you for having me. I'm looking forward to this for a while now. So, yes, and thanks for having me.
Yeah, well, I'm delighted to have you and looking forward to it myself. Before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Yeah, I think it's really for the audience that we're talking about here. I think it'll be hopefully inspiring, because I didn't start out in commercial real estate with that as the objective, like a lot of folks. My background is banking, believe it or not. So I was a finance major in college and started my career at some large name banks that everybody's heard of, and was plowing down that path. But I always had an inkling of, hey, I want to get involved in real estate. And it probably gets back to the fact that my father had a rental property whenever I was growing up. And so subliminally, I just sort of knew that that was a good thing to do without really ever questioning it. But in 2002, while I was 7 years into my banking career, I bought a single family rental in Allen, Texas. And it was a foreclosure. And I bought it at 322 for $100,000, believe it or not. And then I bought another one. And then I bought another one. And this was all still side hustle kind of stuff. I had my W-2 job in the banking world, but I was hooked in real estate at that point. And so over the course of the next decade, I bought several more. And my favorite thing I did every day was got the email from my realtor, my MLS email, automatic email, so I could go through and look and see. And so even though this was my side hustle, it was still my passion in those early days. And obviously, everybody knows at this point what happened in 2008, 9, and 10. The GFC happened, but my real estate holdings actually performed quite well because people needed to live somewhere. And I think that fundamental sort of stuck. And it wasn't very much longer until I had a conversation with my wife she was supportive of it. I was the landlord, I was the manager, I was doing everything, even though this is my side hustle business and we had 3 small kids at the time. It just couldn't scale. It couldn't. I mean, I could have kept buying single family rentals and probably hiring a property management company. There's nothing wrong with that strategy. But a friend of mine introduced me to the idea of multifamily. But I always thought multifamily was multi-millions, institutional. That's sort of what I thought. And I worked at G Capital at the time, which was one of the largest owners of commercial real estate in the world. And so that was sort of a bias, but he explained to me that no, that's not actually how it works 100% of the time. You can actually invest in deals as a passive investor and be a small equity owner in someone else's deals. And so I started doing that. And I did it for two reasons. One, I thought the returns were good for an investor. And two, I knew that if I put my money into a deal, I was going to pay attention and I wanted to actually learn it. I wasn't a couch potato investor at that point looking to just get my cash flow. I actually wanted to learn. And if I put my money in, then I was going to pay attention. And it wasn't too terribly much longer until, as I'd done several of these deals, I was paying more attention to the ecosystem that is multifamily and realized that, hey, you can be on the sponsoring side of this too. You can be a sponsor of deals. And so I was lucky enough to be in a group of like-minded individuals that asked me to join a deal and be one of their co-sponsors. And so I did that and helped raise money. And I was like, oh, wow, this is even better, right? Now I'm involved in the strategy. I'm not just a passive income person in multifamily. I'm involved in the strategy. Now, mind you, I still have a W-2 job. I still have my banking job. But I really, really enjoyed this segment of the business, so much so that in 2017, I was recruited away from banking to go work for a large public company that needed a leader of sales in the multifamily world for their products and services. So now my side hustle had sort of overtaken me and gotten me recruited out of banking that I have been in for 20 years. I still have my own portfolio, but now I'm a supplier into the world of multifamily, attending all the trade shows, attending all of the thought leadership, attending the association meetings, but doing it from the lens of my sales team was selling our software solutions to those owner and operators. And it was great. Kept doing my own deals. Now COVID happens. And the large company that I was a part of decided to divest our business unit. And so as we were going through that sale process, everything was great. I was one of the ones charged with getting our business sold. The day before it sold, as happens with M&A, the bosses came to me and said, hey, great job, Jeremy. The sellers or the buyers, they called last night and said, we're going to close tomorrow. But they also said, we're not taking the executive team. So today's your last day. And I was like, okay. Now, I wasn't worried financially because we've been good stewards with our money, and they took care of me in terms of just how that happened. But I was sort of left at a place where I was like, I don't really know what I'm going to do. I could go all in at this point and be a sponsor. This was around 2000, end of 2020. But then an opportunity came to me where I actually went and joined a pretty large firm here based in Texas that was doing multifamily with institutional capital, and they needed somebody that actually understood investor relations. And so they hired me to come in and do investor relations. And this firm has about 25,000 units today. And eventually they needed me to run asset management for them. And so now I'm in the middle of it all. I am on the owner operator side, 25,000 units. I still have my side business that's going. We worked out any kind of potential conflict of interest, and there wasn't really any, just with the way they fish and the ponds they fish in versus what I did. And now I'm in it. And it just so happens, as this audience knows, that was right at the time whenever I took over asset management, leading an asset management team when interest rates spiked. And we had a fair number of bridge floating rate loans. And so now I'm in the middle of it, trying to figure out what are we going to do, and capital calls start coming up, and working on rate cap expirations and everything that was happening. We had a whole bunch of literal fires that we had to deal with insurance on. And so now I'm gaining, I think, 3 years of experience for every 1 year of actual time. And meanwhile, I have my own side hustle stuff still going. At this point, I've done probably 10 different deals as a sponsor, and all this is going. And then earlier this year, one of our side hustle businesses that I'd formed a few years ago, we made the decision, all right, it's time to not have a W-2. And so we made the jump. Convolo Capital had been started a few years ago, and we said, all right, we're going to, all of our deals had been in Georgia. We're going to expand into the DFW market where I'm based, and I'm going to go out and find some deals under that brand. And we'll end up building our brand in Dallas, Fort Worth, which is a great market to be in. And so long-winded, Darren, on the whole story, but I think it can be inspiring for this audience to say you can start this thing as a side hustle with some passion, and before long, a side hustle can overtake you. You can be in the supplier side of the business, or you can be on the owner side of the business, or you can be in the operator side of the business. I personally like having lenses to all of it because it helps me be a better sponsor, anticipating all of the unknowns that are out there in a way that actually has an opinion where I'm not relying on somebody else. I can actually rely on my own experience.
No, that's that's an action-packed background there, especially with your experience as a side hustle, uh, plus your W-2 experience, professionally as a banker, the banker relations and how critical uh, financing is to the whole game of commercial real estate. I would think that your seat is one that's fairly warm and relied on heavily just for the success of any operation that you're involved in with commercial real estate. I'm curious. So you mentioned the side hustle, and then I think what I understood you say is that the side hustle became Convolo. Is that how
Yeah,
that?
I think that's probably the right way to
Okay,
think about it. The side hustles that started out with one single family 20 something years ago has now become Convolo Capital. And we aren't doing single family deals, we're doing multifamily deals. But there's, starts and stops, different partner groups, different types of opportunities that have happened in that 20 years. But yeah, literally 22 years ago, I bought a single family rental. And then today I have three other partners in Convolo. We do not have W-2 jobs. We are 100 focused on doing the deals, and we've now done 5 transactions at this point. So our portfolio is 5. I've personally done investments in probably 50 different multifamily deals, either as a passive or a sponsor before Convolo. But now we are focused on that brand, now doing deals in the Atlanta MSA where one of my partners is located, and then the DFW MSA where I am.
got it, got it. Well, again, your resume with your experience, the opportunity to work on the bank side, and then also work for another multifamily acquisition firm. You said you did what, 50 deals, you think, with the other
Yeah,
firm?
yeah, it starts to I really can't count. I count every year when I do my taxes and I have all these K1s, um, which is a good problem to have, I guess. A lot of K1s, but yeah, I have this big spreadsheet that I just track, and a lot of them have gone full cycle now. So if I'm just counting the total number, it's probably 55, but several of them have exited at this point. So there's probably 30 deals right now that are in some form of active state that I'm involved in as an investor. Most of them, probably half of them as a passive investor, and then the other half as some form of an active sponsor in the deal.
Got it. So you were able to participate at the former position as an investor as well?
I was, yeah.
Okay.
Unique relationship there. A lot of institutional capital. That business model had us really working with some of the household names in the finance capital part of the capital stack, the large institutional equity. But every one of those deals, large deals, 50, $100 million deals, the institutional partner would bring 90% of the equity capital. And then the other 10% was brought by sort of friends and family. And my job at this firm was to line up that other 10%. And so we, as executives at the firm, could participate in that piece of the tranche. And to the extent that there was still room, then I would engage the network, the friends and family network, to go fill out the rest of that capital stack. So that was particularly helpful. A lot of syndicators are probably listening and want to be in the institutional space because it just seems so easy to have somebody write the single check. And I can tell you, yes, but be careful because they get all up in your business. And you don't just get to, a lot of times on a syndicated deal where most of your capital is, friends and family, a dentist or whatever, they're not going to know and not probably ask you a lot of questions. But I can tell you that the Wall Street banks and their asset management teams, they know what's going on and they are going to be grilling you all the time. And so keeping that relationship sound and healthy was a part of my job. So institutional capital is great because it becomes a force multiplier in your ability to raise equity. But there is going to be the sort of side benefit, if you will, of their expertise being influencing just about everything that you need to do.
Right, right. No, I was gonna say it's almost one of those things where he with the money makes the rules, kind of a thing where
Very much so.
you still have a boss, so to say. And it makes sense. I mean, if they're going to put all their capital at risk, they're going to want to pay a little more attention than if
For
it's
sure.
a bunch of others. And I think a lot of their capital is too raised from their investors. So I mean, they have a
100%.
fiduciary responsibility as well, and you know, so kind of the risk reward there. But sounds like you've I guess the impression I get from just your position and kind of the timeline you've expressed or detailed is you've been through a few fires, which I love talking to people that have been through some cycles, not just an acquisition, improve and sale on a property, but the actual economic cycles.
Yeah.
Because I think that so often the news of the day will portray whatever asset is on fire, meaning like it's going crazy up, up, up. And that always attracts people that all they want is a return. They don't want to understand what they're doing. And they'll come like, crazy because capital's cheap and there's a lot of opportunity and there's a lot of people selling and because capital's cheap, the prices go up and so I mean, it's a perfect opportunity for the high and the low. And if you don't know what you're doing or don't understand the market you're getting into, how easily it is to be on the wrong side of whatever the cycle is. So I want to ask you, you mentioned the '07 cycle when you started buying, and then through the I think you called it the GFC, is that the Great Financial
Price.
Crisis or crash or
Mm-hmm.
okay. Um, how you said that your real estate actually did okay in that. Do you attribute that more to the fact that you were able to buy it, prices that made sense, or were rents rising, demand, or do you have any sense of,
Yeah.
or your financing was fixed, or
So a couple of things, and some of this was just sort of blind luck, I think, but I think there is something to, running conservative principles. So yes, bought right. That always helps. But I didn't have a lot of tenant turnover. So I had a portfolio of, call it 7 or 8 single families during 2008, 9, 10. And during that 3-year period of time between my 7 single family rentals, I know I had less than 30 days of vacancy. Why? Well, I had a strategy that was I am deliberately going to keep my market rent a little bit below where market is. And that is going to keep the existing resident renewing. And if I have my costs relatively fixed because I did have fixed rate mortgages, then modest rent increases just to keep up with insurance and tax increases was completely fine, but I was always keeping the properties $100 to $200 below where I could have been had I been forcing the rent. And so it kept me from having to deal with tenant turnover. And, even at that point in time, I didn't really fully understand it like I do now with a multifamily lens, but I know that I had one of my houses, I had a resident for 16 years before I sold the property. And so I didn't have to worry about collecting rent. And that resident was somebody that I didn't have a whole lot of R&M. They fixed the stuff themselves. And again, this is single family world. And so taking care of the resident by virtue of treating them with respect, whenever they called, I fixed stuff, and keeping their rent at a level that was high enough to meet my cash flow needs, but not sort of gouging at the high end of the market, kept me with a near 100% occupancy during that really difficult time that maybe others didn't have. And so my real estate holdings, and again, I had a W-2 jobs at that point in time too, really kept my stress levels down, because I honestly looked at it like, I'm sure glad I've got these real estate investments, because they're holding me up while the stock market is tanking my 401k at work. So that was maybe the best sort of looking backward, was if I treat my residents really well, they'll stay, and I won't have to deal with the turnover and all the work involved with turnover, showing and making sure the property's right, and all of that stress just from my time. Because again, I was the manager of the property, landlord, and honestly kept my marriage in a good place too, because I had small kids. And if I was actually having to deal with tenants all the time, then we would have had to sell them, and it would have been the wrong time to sell, and it would have been horrible. But it was that strategy probably more than anything else, which it taught me some things that I think is the focus of what we're going to talk about today. Is it really talks about what I call social impact, and why social impact is good for people and it's good for business at the same time, and how you can marry those things together, I think is a winning strategy in society, and it's a winning strategy for owners, and it's a winning strategy for investors too.
No, and I appreciate you kind of going through how you weathered that time, and I firmly believe in that same kind of strategy. We exercised that in our some of our properties, and it's served us well. And the fact is that the turnover cost is usually more expensive than the vacancy cost. If you've got to do a lot of repairs in that. But let's get into the topic that we're planning to talk about, and I guess also kind of understand, or would look to you to kind of understand how you have implemented. And let me back up here one second. Be clear. So the topic we wanted to talk about was how social. What do we say it is? How social
Social
impact
impact.
initiatives are good for residents, employees, and investors. And this all falls under the ESG kind of
Right.
blanket of topics: environmental, social, and governance. And so I guess I would first ask, as a strategy, how do you look at the social impact
Mhm.
uh, in your current position, and does it vary much from the way you used it back when you were
Right.
initially starting?
Yeah. So, yeah, I'm super passionate about this. So, yes, I'm passionate about real estate, but I'm also passionate about doing good. And there's a lot of reasons for that are probably beyond the scope of this, but I'm a religious person. And so, whenever you think about the intersection of doing good in society, that is a big driver for me. And so it occurred to me back in the GFC days, if I treat my residents with a lot of respect, then they will treat me with respect too. And so I was learning some of those concepts as I was going, maybe not even fully realizing. But what ended up happening is at one of the firms that I was investing with, they had a social impact strategy, and I thought that was really, really interesting. And then this was about the time when the letters ESG really started catching some brand momentum themselves. And so there's a lot of focus on the environmental, and there's a lot of focus on government. And the S was sort of the soft part. It didn't stand for soft, it standed for social. And so ESG initiatives started becoming something that people were talking about, institutional capital was talking about in their investor calls. And it always just felt like that the S was sort of getting patted on the head while they focused on the E and the G. And I was like, you know what? That S is in fact treating the resident with respect. That's treating the resident. They are your customer, if you think about it, if you're in the rental business. And so every one of those residents is a person, and some of those people are on the lower end of the economic scale and some of them are on the upper end of it, but they're all people that are treated with dignity and respect. So then how do I come around that idea and think about what are the needs of that group of people as my residents? And it's the full gamut, depending on if you're talking about renter by necessity or renter by choice. And a lot of the deals that I've been involved in have been more on the renter by necessity. So call them workforce housing, attainable housing, affordable housing. There's a lot of different words. Some of them have a lot of baggage with the word affordable in particular. But the idea is that what would happen if the intersection of a whole group of nonprofit world that really wants to help people intersects the world of housing, where you actually have ownership that would love for there to be social programs for their residents, but there is a chasm that's in between that doesn't have the people, the nonprofits with direct access to residents and ownership groups that don't know about nonprofits. What if I can make that easier to connect? And there's a number of different nonprofits that are out there that can provide services to your residents. And oftentimes, as the owner, it's free. The nonprofits have their own funding. They have their own grants. They just want access to residents. What if I'm actually opening up my eyes to the opportunities that nonprofits can come in? And there is a number of them. And it doesn't have to be some big initiative, but it could be. It could be as there's a whole different, when you start really opening your eyes to the different ways to impact your residents. One of the things that my former employer was super passionate about, and they were this. I should have said this before. So I was introduced to this social impact concept as a passive investor for my former employer, who eventually I invested with, and I eventually became an employee there. And then I really was emboldened with this idea. What would happen if we surveyed our residents and actually asked them questions like, hey, what are the things that are important to you? Childcare. What about English as a second language classes? What about nutrition? What about financial literacy? What about all of these gamut of different offerings? Because there's nonprofits that are out there that want to serve, whether it's the faith-based community or it's the nonprofit world. What if I can actually connect this? And now I'm creating community on my properties. So from a business point of view, I don't have to pay for a lot of these things because the nonprofits want access. I just have to provide access. And what would happen if community is created and that resident wants to renew because there's a lot of great programs that are going on there? And not only renew, they want their cousin to come live there too. They want their best friend from high school to come live there too. And now I've got a referral source and I've got renewals happening at a higher rate. It's really, really good for business. And so those passions of mine, doing good in the community and being a good owner operator, started intersecting. I call it my worlds colliding. And so I'm involved with a number of different nonprofits, whether it's local food banks, local church. I was on the board of the YMCA. All of them want access to residents. And if I can help facilitate that, then it's really, really good for my business too.
No, I think the takeaway from just what you described there is building community. I think so often in today's world, people are so into their own little world that they may not even know their next door neighbor.
Right.
And I think that, the more isolated people are, the easier it is for them to come and go, and nobody knows, or there's no attachment to not necessarily the place, but the people in the place where you live. And if you don't have that attachment, it's there's no reason for you to stay. So what's keeping you there, kind of thing, which just creates more of the turnover kind of thing from a landlord standpoint.
For sure.
So let me ask you. So you described that there's all these nonprofits that are available. How did you set about? Did you first get in touch with the different nonprofits, or did you survey your residents to determine, what the issues are that need to be solved?
Yeah, great question. So because I do a lot of work with nonprofits in just my personal life, I was listening there. And so it became pretty clear to me that I was literally in a meeting at my church, and our outreach director said, we would really, really like to figure out how to reach into that apartment community. It's like 500 units. It's right across the street from our church. And I'm like, have you talked to the owner? I was like, no, how would I do that? I was like, well, it just so happens I know the owner. So a little of it is just paying attention, I think is probably the first thing. Um, but then as you target particular properties at a particular demographic, so ABC properties, you can actually go in with a strategy. So again, my former employer, large institutional capital, and the institutional capital is looking for social impact initiatives. If you're on the front end of a deal, one of my favorite stories talks about how my former employer, we actually recommissioned an extra clubhouse at a large community and turned it into what's called a Kids U, which is a nonprofit that effectively comes in and creates I'm just going to call it a preschool, sort of after school, elementary school that does after school care, tutoring, field trips, teaches, and this is a free amenity for the residents. Talk about a differentiator. That is huge. And we've had a lot of momentum with that concept. And again, we don't have to be the providers of it. We found a nonprofit literally called Kids U that came in, and all they needed was the facility. And we had the footprint of a facility. We just had to make sure that as we were buying this, that we had enough CapEx dollars set aside to transform that extra clubhouse into something that wasn't a clubhouse, that was more of a school. And so we did that. That's a
So,
that's a big example. There's a number of them that are much smaller that can be deployed really, really quickly that are still in the vein of social impact as well.
yeah. So you it sounded like on that one you were more plugged into the nonprofits personally and recognized that they were trying to reach into the communities that you were either invested in or knew of, and were able to make the connection there between the two. On from so I guess the question is, I guess at some point you've got to have a sense of who are the residents and what are the
Their needs.
services that are available, and figure out kind of how they can
Right.
work, or put those two together. So once you have that survey and you have that kind of a sense of who the um, different services are that are available, how do you set about measuring the
Mhm.
the effect that, or do you measure the the uh, the benefit or the effect of the social impact?
Yeah, this is a great question, Darren. And I actually spoke about this on a panel at the Apartmentalize conference this last June, because measuring the S is harder. In the ESG, there's a lot of ways you can measure environmental, and there's a lot of ways you can measure the governance piece. The S piece, measuring, is trickier, but that doesn't mean that there's not ways to measure it. So one simple way that I think will resonate with this audience is you could actually say, okay, before we deployed something, and then after we deployed something, what is the financial metrics of our community? What does renewal rates look like? For residents that are engaged in that particular social service versus residents that are not, what does the renewal rate look like? So there is some, if you think about it, there is some just logical KPIs that are in our normal operating rhythms that you can actually start measuring with the lens of with or without the social impact initiative. And so there's some basic things that can be done there. If you get all the way to the institutional level, there's actually an organization, I can't remember what it's called other than the acronym is GRESB, GRESB. And so GRESB is an initiative that institutional partners are trying to build together to figure out ways to measure social impact programs. So that's an extreme case on the institutional side. On the smaller sort of syndicator side, I think there's some basic sort of KPIs that you can look at and you can say, hey, what does our renewal rate look like differently after we deployed something? I'll give you another example of something that's pretty easy to deploy. So a technology example. So in the last 10 years, there's been a realization that rent is not something that typically is reported to the credit bureaus, rent payments. So there's been some evolution in the prop tech space that say there's rent reporting, and there's several different rent reporting companies at this point that you can partner with. And rent reporting can be something that you offer your residents. So somebody might ask, okay, what does that mean? Well, for a resident that's a renter, the largest part of their budget, their monthly budget, is their rent payment. And for the most part, they're not getting credit on their credit, so to speak, for a rent payment. Well, if you deploy a rent reporting product, then all of a sudden that $1,500 a month in rent that's being paid regularly and on time, it's now being reported into the credit bureaus. And what happens oftentimes in this case is they can actually go retroactively the last 2 years, and you can see a resident's credit score jump 100 basis points. That's measurable, and that is super impactful for a resident. That's
not
a
on
simple
not on
example.
their lives. I mean, globally, from the standpoint of you go to buy a car or whatever,
Absolutely.
the interest rate that you're offered is directly proportionate to your score there. So
Another
that's
another simple example is a lot
yeah.
of times um, whenever you're moving in, a lot of communities will require a 1 month rent security deposit. And security deposits are something that has just always been in our space. And some markets have higher, some markets have lower. There's a whole ecosystem now of security deposit alternatives that people don't have to pay a full security deposit. They can pay a fee or a rent premium that's much, much, much lower. Well, what does that do? Well, if you're a resident that has to come up with 1 month rent and a full month rent of security deposit, and you're living paycheck to paycheck, and you don't have your security deposit returned yet from your prior place, there's a massive cash flow issue with moving. So there's a whole ecosystem now of security deposit alternatives that are out there that you could deploy as an owner that allow for they play into the affordability side to allow residents to move easier. And oh, by the way, as an owner, most of these programs have even better coverage than what that security deposit would give to the owner. So it's like the concept of I can provide something that is much easier on the resident to move in, and it also provides better coverage than a traditional security deposit at the end. Again, another example. That's a prop tech, insure tech example of something that you don't have to have a big CapEx budget or an institutional capital to transform a clubhouse into a kid's U. That's a tech solution that can be deployed, and a resident or an owner, a syndicator, they don't have to pay anything for this. It's actually paid for by the residents, but it actually creates a lot of momentum at the resident level, and you're taking care of your resident and you are protecting your property better. So again, those are the two extremes, right? Prop tech, insure tech, and solutions that don't really cost me anything. The other extreme is building a whole new school on side of your property. And there's a myriad of things like after school care, nutrition classes, YMCA safety around water classes that the YMCAs will come to your community if it has a pool and teach swimming lessons in the summer. There's just almost an endless number of opportunities that you can delve into. And again, these nonprofits, these solutions, they want to be there. And it's my job as an owner to find them and then deploy them to my residents, taking care of my residents. Now my residents renew, they like the community piece. It's good for business.
Yeah. No, and it's funny because I think that sometimes it's easier to identify on the social things, more like the nonprofits that will come in, but not necessarily something you would think of like the financial reporting. Because it would probably be presented to a landlord or a property manager more in the way of an accounting
Right.
thing, as opposed to, oh, and by the way, we give this benefit, and attaching the social benefit to that may not be as direct when you're looking for the solution that you're focused on the benefit for you, in your accounting or whatever that is, not necessarily understanding the benefit you can provide to your residents there.
Absolutely.
Um, so on the it sounds like the opportunity is unlimited as far as identifying what can benefit the residents, and then try and find a solution that will help them. Um, you know, the the financial thing, I think that one to me is an interesting one, just from a standpoint of I would think that anybody who is aware of their financial score is also and knows that it's increasing, wants to keep it there. And that all, I mean, it's proven out. I know insurance uses it for rates.
Right.
They've determined that if you have a better score, you're less likely to turn in small claims because you'll take care of yourself because you know it'll affect your insurance.
Yep.
And I think that that to me is genius. And I'm wondering, do you have any sense of what prevents landlords, investors, property owners from doing this? Is it a lack of awareness? Is it a lack of want?
Yeah.
Is it?
I have to tell you, you asked the question. We didn't even prep this. So I used to be a supplier and I was selling screening services to all of the property managers in the country and leading a big sales team. And I would always get frustrated when my sales guys would come. It's like, hey, great meeting. They really think that our products are the best. Our price is right, but they said they don't have bandwidth. And we need to come talk to them next year. And as a sales leader, you're just like, basically they want it. They can't prioritize it. And so that is my answer, because working when I flipped the script on myself, went from being a supplier to being a executive at a big firm that had every supplier and their brother trying to get a hold of me every day, and having a whiteboard full of 50 really good ideas, knowing that I only had the bandwidth to do 3 or 4 things. That is the issue. In the property management world, the issue is there's always a fire, and sometimes it literally is a fire. And so you're just moving around from fire to fire, and it's really difficult sometimes to prioritize something that you might not have exposure to. You might just wonder, and you just don't have the mental capacity to just deal with something new while you're dealing with fires, literally and figuratively. So I think the biggest inhibitor is really prioritization and making sure that there is enough. You almost have to find a champion of that cause at that particular owner operator that really has a passion for social impact in this case. And then those social impact initiatives then get sort of overweighted in how that particular company is thinking about the key initiatives, the strategic initiatives that they want to deploy. And I think that's the best answer I can come up with, as well as sometimes I think our industry is a little old school, and it's like, hey, we provide housing, people need to pay the rent, we're going to provide a safe place to live, and we're going to go on down the road. And I would just challenge aspiring people that want to be landlords or owners to invest in education. And I'm not talking about, book smarts. I'm talking about like go to the trade shows, um, go to the big events that are held by the industry, and you walk around some of those and you realize that every business in there is actually trying to solve a business problem, a pain point for our industry. And it was such a pain point that somebody created a whole business for it. And there's a lot of them actually that are very resident centric. And there's a lot of them that are even social impact related. And so it just ends up sort of being a invest in the awareness, because when you have awareness of something, then you start learning about it. And then slowly but surely it starts creeping up the prioritization list. And you only have so much bandwidth to go deploy different strategies each year. And so then you realize, wow, if we don't do this one, or this one actually is such a low effort that we can actually add it, get an outsized benefit because it really is low effort. I just needed to understand that it was low effort so that I could prioritize it.
No, that's well said, and I'm certain that that's the the investors or landlords that I deal with, I think in the big picture, they'd like to do well, and they understand that the residents are kind of the golden goose. You have to have good residents to pay the rent on time and all this. And if there was
Right.
something that was easy to do to improve the situation to where there was create a sense of community or just improve the lives of the residents, I think, especially for no cost. I mean, that's, no or little cost. I think that most would recognize the benefit of that. And like I said, just kind of the bandwidth kind of thing. Yeah, I'm curious, one more question here
Mhm.
on this. Is there any kind of a size of property where you feel like this, um, it makes it more available, or is it something you could have done with, just your first single family rental?
So the answer is it just depends on the initiative, right? Obviously, I'm not going to build a clubhouse on my next to my single
Right.
family rental and put a
Right.
school in. So it definitely, I think the bigger the property, the more opportunities. But that doesn't mean that smaller Convolo Capital, I mean, we are 40 unit, 50 unit, 60 unit kind of guys at this stage in our business life cycle. So we're looking at the insurtech, prop tech solutions that I referred to before. We're looking at partnering with nonprofits for there's some nonprofits that are I want to say halfway house. It's like the graduation from the halfway house kind of thing. And so what if you actually did a corporate deal with a nonprofit and you actually brought in people that will a nonprofit's now going to pay your rent and you're going to have people that are living there that really couldn't live someplace else. And how do you get comfortable with what that risk might look like? So that's an example of something that can be done on a 40 unit or a 50 unit property. Um, there's nothing that stops you from being involved with, like, the local PD probably has crime watch programs. So open arms. Let's put a crime watch program on. Let's develop community in a crime watch program, and the PDs will love you for it. So that's an example of something that's not going to cost anything, just a little bit of organizational might. Getting involved with the faith community. A lot of faith communities want to come deliver turkeys on Thanksgiving, and they do it for free. So it's just being aware that the Church of Christ the Street actually wants to have relationships with your residents, and they'll do things that they don't have to get all churchy. They just want to do good in the neighborhood. And so being open to that idea is really good for business.
Yeah, that's awesome. Hey, Jeremy, if we could, I'd like to shift gears here for a second.
Sure.
By day, I'm an insurance broker, and as such, I work with my clients to assess risk and determine what to do with the risk. And there's three strategies we typically consider. We first look to see if there's a way we can avoid the risk, and that's not an option. We look to see if there's a way we can minimize the risk. And if we are unable to avoid or minimize the risk, we look to see if we can transfer the risk. And that's what an insurance policy is. It's a risk transfer vehicle. And as such, I like to ask my guests if they can look at their own situation. Could be your clients, investors, tenants, the market, the Fed, whatever it is that you identify and consider to be the biggest risk. And again, for clarification, while I am an insurance broker, I'm not necessarily looking for an insurance related answer. And so if you're willing, I'd like to ask you, Jeremy Thomason, what is the biggest risk?
Okay. Man, this is a great question. We are sitting here. I don't know when this will air, but we're sitting here on a Fed day. Um, so the obvious answer to me would be interest rates. And so honestly, I'm not going to answer that because that's just an obvious answer. And I actually have an insurance license too, and I sit in Texas. And so it'd be very easy for me to say, well, it's the high cost of insurance. That's an insurance. That's just a really big problem right now for our industry. And in Texas, renewals, everybody's scared when their renewals come up because it's just going to be a bad news story. So it'd be easy for me to say, well, it's insurance. And those interest rates in insurance are not really controlled by us in a lot of cases. So they do represent big risks. But I'm going to say it is something that I've learned through this last cycle. And so it's related to insurance and interest rates. There is a tendency, I think, in our space to want to go chase whatever the absolute best deal is. So I'm going to use lending as an example. 3 years ago, the whole space thought that the forward curve on interest rates was going to have near zero interest rates. And everybody, institutional capital, everybody thought, you know what, the best deal in town is to go ahead and do a floating rate loan. And you'll cap yourself, you'll protect yourself with an interest cap, and you'll be fine. Obviously, won't go into it. That was a mistake by our industry. Nobody could see coming 500 plus basis points of interest rate movement within a year. Never happened like that before. And it's put a lot of stress on our industry. Similarly, insurance. The insurance markets call it catastrophic risk, high probability, high frequency, all of those different things, coastal, all those things have put an upward pressure on rents, and we couldn't anticipate it. So my answer is on the risk thing it's the risk of uncertainty. And so how am I going to answer this? I'm going to answer this by saying I am much better off working with someone that has experience in the space and taking risks off the table. So floating rate loan at 2.9, I could have gotten a fixed rate loan at the time with a little less leverage at 4. But that 125 basis points was sure nice in my modeling, but I should have taken risk off the table because I only had a 5-year hold. So uncertainty is my answer. It's the uncertainty. And the way I'm answering it is my job as a fiduciary to my investors is to take as many risks off the table as I possibly can, because God knows that there are so many different risks that I can't control and are going to hit me. So if I can eliminate risks in how I underwrite or how I use products and services or how I look at a particular basis of a property and take as many risks off the table as possible, then I'll be left with still a substantial amount of risk, execution risk and unknown risk. But my job is to eliminate risk. And I can do that in different ways because there's all kinds of different risks. But the answer is the uncertainty risk to your question, Darren. I know that may be too vague, but that's what I worry about is uncertainty. And how I have learned in this last cycle is it's better for me to have certainty at a little higher price than it is for me to just hope that everything's going to be fine and chase the better priced product, whether it's insurance, whether it's interest rates, whether it's a contractor. Certainty wins because I can underwrite certainty.
Yeah, amen to that. The the market certainly has thrown a few curves, and the uncertainty is increased the risk for a lot of investors and the market at large. So appreciate your answer on that. Jeremy, where can the listeners go if they'd like to learn more or connect with you?
Yeah, thank you. So our business is called Convolo Capital, CONVOLO capital.com. You can go to our website. My email address is Jeremy, JEREMY at convolocapital.com. You can engage there. And I like talking about stuff. So, if you want to engage with an email or we'll set up a phone call, whether you ever want to be an investor in one of our deals, that's not the point. I like expanding networks. And if this talk inspired you, chances are you have a nonprofit that I haven't thought about. And so that is something I am super passionate about and would love to talk to anybody about it. Convolo means in Latin, fly together with others. And so it's an appropriate way to think about how we think about our business. Those others could be investors. Those others could be suppliers, vendors. Those others are residents. And so we want to fly together with our residents.
Awesome. Well, Jeremy Thompson, I can't say thanks enough for taking the time to talk today. I've enjoyed it. I learned a lot, and I look forward to doing it again soon.
Awesome. Well, I appreciate the time today and look forward to the next time.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.